JP Morgan's new tax saving machines, introducing two brand new accounts, the ROCY and the ROCQ. JP Morgan's new tax-deferred income ETFs. Hey everyone, welcome back to the channel. I'm Doug, the Retirement Guy, and we're going to break down the two new JP Morgan Asset Management funds that they came out with, and basically why they brought them out, what's their intent of these things, and is it good for a retirement account or not for a retirement account? So we're going to dive into that today. Well, before we got to get into this, we do have to do a disclosure because we're technically rated as a financial channel, but the past performances do not guarantee future results, and the information provided in this video is for educational informational purposes. It is not to be considered financial advice. So meeting the new funds. ROCY is JP Morgan's Equity Premium Yield ETF, and its equity is focused on the S&P 500. Now, it is the U.S. large cap equities. It's a broad market exposure with monthly income. Now, the ROCQ is the JP Morgan Nasdaq Equity Premium Yield ETF, and it's really focused on the Nasdaq 100, that tech and innovation leaders, the high growth Nasdaq exposure with that monthly income. So already right off the bat, I'm going to kind of break something down here for you. The ROCQ is really designed off of the Nasdaq 100 across the board, while the ROCY is using the S&P 500, but primarily looking at the large cap equities. They're not following it to a T. So they're not really going to report this and say, hey, we are an S&P 500 company. They're going to do the things that are going to generate income and work well inside the fund. So they're not going to follow it 100%. Now, a big thing here is the expense ratio is 0.35%. And it's one of the most competitive fees in the derivative income ETF category. So they're giving you a very low expense ratio, and they are already telling you they're into the derivative income, so their income generated funds set up accordingly. So the question was, and I asked this, is why did they come out with this? You know, they have the JEPI and the JEPQ. They've been there for the old-fashioned way, been there for years, over $80 billion in assets. Why would they come out with two new funds that are almost carbon copy from each other? Well, it comes down to a battle of the taxes. If you know JPEI and JPQ, distributions are taxed at ordinary income. So that could be up to a 37% gone before you reinvest a single dollar, depending on your income, of course. But when you're taking ordinary income from the fund that they've done it, I call it the old-fashioned way, you have to pay those big taxes on that. So we always have suggested that you put this into a fund that is actually based off of a 401k or a retirement package like an IRA is the safest and best place to put these. The new way is what they're doing here. They've have that lower expense ratio, but they're using a return of capital. Okay, we've talked about this on the show many different times. Return of capital is got a good and a bad flex to the two. Okay, the good of it is it kicks the can down the road. It takes your tax bill down the road so that you don't have to worry about paying the taxes on the dividends. Only basically when you sell it. Now, the negative to the return of capital is when someone uses it to keep their yields high, like you see in a lot of these weeklies that have been out there. They keep the yield high by returning your actual capital. It's a double-edged sword. So it's a unique thing, and using it under the JP Morgan side, I'm going to go more towards that it's going to be a nice benefit for deferring your tax bill down the road. So what we're coming back with is nearly $80 billion in JPI and JPQ, but investors are losing too much in taxes. That's why this new funds came out to change that little problem. So you get the products into the right mix, into the right category, into the right funds, and things work out to be great. So let's explain a little bit more about the ROC. I want to make sure everyone understands this as simply and as easy as I possibly can. Your distributions quietly work for you in a tax-deferred way. So if you bought into these shares, and we're just going to say the average cost was $50 to buy one share of ROCY. Now, your monthly distributions, if the ROC pays out and it's paying out $1, so you're getting $1 of distributions that are classified as the return of capital. On paper, in your account, your ROC distributions received, your cost would be reduced by the payout amount. So we're using $1. So your new cost of your funds is $49. Okay, hopefully I didn't lose anybody there. You had original cost of $50. You got $1 in distributions. So on paper, you now say your cost is only $49. So when you go and sell your funds, you sell your shares at $55, your cost on paper was actually only $49 because you got those distributions paid to you. You technically have a $6 gain, $5 from growth, a 10% growth, and your cost went down only $1. So basically what you're doing is you're getting capital gains taxed on that $6. Now, the nice thing about this is you're only doing this when you sell your shares. So you actually are reducing your tax deferred until the moment, not every single month. So we're not taking money out every month. And if you sell the fund for a loss, you're actually going to have no taxes. If you're going to be in the long-term capital gain, you're going to have major reduced funds. So hopefully I made that easy and understanding for everybody why ROC is such a good piece in a tax program. And it doesn't matter if you're in a 401k, an IRA, or just a regular brokerage fund. This works identical to each other. So let's take a look at the landscape that's out there and look, JP Morgan with these new funds, since their funds are different. We already showed how they are different from the JEPI and JEPQ. We're going to take a look at it up against NEOS's SPYI and QQQI. Right off the bat, the lower expense ratio, 0.35 to 0.68 to 0.98. So what this means is, I always do it in 10,000. Suppose $10,000 invested, $35 is going to go to JP Morgan for operations, while NEOS is getting $68 to $98. So the expense ratio is definitely higher in NEOS than it is in JP Morgan. Now the tax strategy, they're going to use that ROC, which is that tax deferred until sale. And NEOS uses those 1256 contracts, which is a 60-40. So 60% long-term capital gains, 40% short-term capital gains. So very similar type application, except NEOS is going to give you that on a regular yearly basis. While the JP Morgan, you could actually defer this out for 2, 3, 4+ years if you're not selling the funds. Now the management. Now JP Morgans are going to be a completely active team, same as they use in JPI and JPQ, versus NEOS actually uses a NEOS passive strategy. It's an index-based approach. So more, I wouldn't call it rules approach, but it's kind of similar to that, where they have their rules that they're going to set up with. They have the index that they're setting it up with. So you really have someone watching, or a team actually watching more of your money when we're going to the JP Morgan. So when you look at it, it's about 50% cheaper than NEOS. And the tax treatments at the time of distribution with NEOS, you kind of lean more towards that deferred tax bill when you get into the JP Morgan. So I'm going to put it here on the tax side of it. Yeah, maybe a slight lean to JP Morgan. I still put it as a balanced approach between the two. But I do like the lower expense ratio and the management being totally active onto it. Now remember, don't take my advice. I am just giving you information. I am the regular retail investor like you are, making a lot of mistakes in markets today. So inside the portfolio, this is what I started really looking at and saying, what are these guys doing? What are they bouncing with? And I found this comparison. This was kind of interesting to me. Is that even though we have an S&P 500 and we have one that's Nasdaq 100, one of the main pieces of the common thread between both of them was right here, was in these five tech giants. Nvidia, the Y is at 8.16% of the portfolio is into Nvidia, while the Q is at 9.04. Apple, and the Y is 6.59 and the Q is 7.86. Microsoft 5.63 to 6.19, Alphabet 4.78 to 6.44, and Amazon, they're about equal with each other, about 4.07 to 4.90. So the S&P 500 one, the top 10 holdings concentrate is over 40%, while the top 10 in the ROCQ is 51%. So heavy tech concentration, active options overlay used to manage that volatility. So if we get that big tech run again, which is a lot of people talk about, the AI, and it's one of the big things they're starting to see coming out of the Iraq war side of things, that you might have seen the new version of war that is a heavy AI mix. So if that happens, these guys are going to see a big bounce again in that whole tech side of things. So the performance, the wild cards that we look at, as we sit right now, I got to clarify right off bat. We are so new with these funds, and the market's been bouncing every which way across the board. We can't really give you a judgment yet, except that the ROCY and ROCQ from JP Morgan, even though it's down, time of this video, which truthfully I was going to tell you, it changes hourly, changes by the minute. We had a great day yesterday, and we were already had this pre-programmed in. Actually, it was down 1.17, while SPYI and QQQI in the same exact time frame is down 2.03. So they are already starting to outperform a little bit. I would not hang my hat on that one to say, hey guys, this is a great switch over. But these are just another option available. Others are in the ring. We get the Goldman Sachs, which we've talked about, funds that we really enjoy, GPIQ and GPIX. There are option premiums based as well. So it's another one that we're now putting JP Morgan into with NEOS, and now Goldman Sachs are all fighting in for that same kind of pattern. The TSPY, TAP Alpha, that zero DTE option call, that is a wild card out there. I'm not saying it's a bad fund, but I'm saying it's different from what these guys are actually doing. And like I said, the ROCY and ROCQ, both from JP Morgan, right now with that turn of capital and active managed and the low maintenance fee, it's really showing out to be the real leader in this little category, in this little section of it. Now, I said before, the early data only, 6 to 12 months of additional performance is needed for giving you a meaningful conclusion. If you've watched this channel before, my training, my thoughts on everything is you don't just jump into a portfolio, don't just jump into a fund. You got to give it that I always say 6 to 8 months minimum, 6 to 12 months realistically, before you see how the fund's are actually doing. How well is the guys that are watching it and doing it? We know what Goldman Sachs has done. We know what NEOS has done. We know what TAP Alpha has actually done. So we really got to get some time under their belt to see if JP Morgan's got a home run on their hands, they got a single, they got a double, maybe it's a strikeout. We don't know yet. So I want to make sure everyone understands that we do need more time to really dial in. But it's something interesting how these new funds have almost like we're creating our own little segment, our own little category built around taxes, income, and now expense ratios. So very, very interesting piece. So the strategy, and I always say the verdict of everything: taxable brokerage accounts. The ROC defer works here, works really well with these new funds. If you have a brokerage fund that you're doing, it's kind of like, hey, look at you. I'm going to say this now, but it's not guaranteed that maybe these are the funds to go look at instead of JPI and JPQ in your brokerage account. I'm not saying they're bad funds. I'm not against them. I'm not doing anything negative to it, but I'm just saying that if you have a taxable brokerage account and you like the JP Morgan stuff, these things could really sit in there fairly well. The Roth and IRA holdings, ROC completely adds little value. That's why I say JPI and JPQ may serve a better setup for this. When I did my study, looked at it, tried to figure out why they were doing this, and I can see it very clearly. And these two almost like break it right down, exactly how I look at this. If you have a brokerage account, these things will work well. If you have a Roth and IRA, I'd still probably be in JPI and JPQ just because of the past performance of what they've done. But everything else is, I'm telling you guys, is a wait and see. I'm monitoring this 6 to 12 months for the distribution consistency, the NAV stability. How is it performing? What are they doing? I'm not going to have the fear of missing out. I'm just sitting back waiting to see how this goes. Like I said, 6 to 12 months. So it's promising. It's a promising design. It's a promising piece of the puzzle, but it's just not yet proven. And that's one thing. The early year-to-date data favors what they're doing over the NEOS packages, but long-term distribution stability is still unproven. The assets under management growth, the NAV behavior, and over the next year will really tell the true story. And we want to see how well these guys do. Everything they've done so far, I really like. I love the low expense ratio. I love the way they're using the ROC, the proper way of doing it. It gives me an option for my brokerage account. I have the other options still in JP Morgan for the Roth stuff. So let me know what you think. Tell me give a comment down below. What do you guys think of these new funds? How do you think you would use them? Do you think you'd even use them? Let's give me some input. We're going to follow back around this probably 3 to 6 months area, come back with another video on how they're doing, give you a little more insight to it. But I'd love to hear what your guys thought of these new funds. Also, don't be afraid to hit that subscribe button and also hit that bell notification. Hit that like button. Helps us the best with all of these videos. So let's take a look at our back test that we did, the performance and the comparison. So starting off with 100% reinvestment. So we received 0 cash in our pocket. The ending portfolio value was worth $452,143 from the $525 that I originally was started with. So that gives us the worst total in return of negative 14%. When we did the 50-50 reinvestment, so $58,000 was cash that we received in our pocket. Our portfolio would have ended up at $402,760, down 12%. So this is the middle of the road. And then if you were like myself, taking out all of it, 0 reinvestment, taking all the money out, you would have collected $110,000. Your portfolio would have ended at $358,000 or down 10%. So you hear this a lot of people, oh, reinvest, oh, 100% drip. Well, I just show you right here that actually reinvesting in this fund has not done anything for you. You've actually fallen behind with 100% drip. And this is why we do these things. This is why we do these checks and samples and find out which way it is. And you may ask, why is it that 100% reinvestment is not a good, strong piece on this particular fund? It's because of that 31% price drop-off. Okay? The price of the shares continue to drop. The dividends continue to drop. So you're not getting as much money to buy more shares or enough to cover the loss that you're doing. So you start adding these things up, and I can tell you, If you start adding this up in the zero reinvestment side of it, you're at $468,000. Okay, you're at 460 on the 50% and you're at 452. So you can see that even that the money that you're taking out, a lot of that cash that you've received is still your own money that just came out of your portfolio. So I almost want to tell you that there was no return on this. Was none of your money was reinvestment. None of this money. This is all your money coming back to you because you started off with 525,000. You collected 110, and your fund went down to 358. So out of that 110, a good chunk of that was your own money coming back to you. Reinvesting into a falling asset compounds the losses. The portfolio loss of 166,000 in principal while returning only 110 in income, that's a net loss of $56,000. So this is what I'm trying to explain to you, and I put it in plain, simple words. So this portfolio, doing that 0%, paid you $110,000. Sounds great on paper. Looks awesome. Your wallet's nice and fat. Your net loss, though, is $56,000. So you're going to pay taxes on that 110 of income when you actually lost $56,000. So it's almost like you're double taxing your own money.